Alright everyone, Cowboy Trades here. Welcome back to the channel for another update on Bitcoin. So Bitcoin has just smashed through the 30,000 US dollar level as it confirms a bullish breakout from this ascending triangle with a price target all the way up at $30,750. But while everyone is currently getting bullish on Bitcoin, I'm going to be selling and updating my DCA plan, which we haven't talked about on the channel in the past 5 months. Now, we're going to update this DCA plan and what I'm going to be doing with my Bitcoin sales at the end of today's video. There's a lot we need to talk about before then. Of course, the lower time frames, the breakouts, what price targets to keep your eyes on, some on-chain data, an update on the SP 500, and of course, this week, literally tomorrow, we do have the CPI data coming out, and there's a very strange and interesting divergence which is going to be happening with the core CPI and the headline CPI. We're going to discuss all of this and more, but let's dive right into the lower time frames. Now, like I said, Bitcoin is breaking out of this ascending triangle / ascending wedge, however you want to look at it, with a price target up at 30,750. Now, I apologize, I'm a little bit late to the party on this one. I was away yesterday and I wasn't able to update this. I did, however, post this chart over on Twitter while we were breaking out round about 29,600. This is why I always recommend to come and follow me over on Twitter. I'm not glued to my chair making YouTube videos every single day, so sometimes I will be away and miss when these breakouts are happening. This is why, like I say, come follow me over on Twitter and I will post when I do see these breakouts happening in live time. So like I said, from this chart, from the tweet update, there is no change in the price target. It is up here around about $30,750, which is about another 2% away from where we are right now. Now, of course, this may just be a bullish breakout because of this consolidation range, or it may just be a pump into the CPI. A lot of the time, we do have these pumps into the CPI before we do proceed with a dump post CPI data. Nonetheless, I do see things being short-term bullish with a little bit of continuation looking up to round about 30,750 in the immediate short term. Now, if I zoom out a little bit further on this chart, this isn't my personal prediction. This isn't how I see these charts right now, but there is also an argument to be made that this is a bullish pennant breakout with a price target all the way up here at 42,300. I really think we should see how this 30,750 price target reacts and then see what the CPI data comes out, and then of course we can reevaluate the market at that point. Like I said, this is not my prediction. I don't think we're coming up here. Nonetheless, I did just want to cover both sides of the coin, but in the immediate short term, coming into the CPI meeting, it's likely we get a little bit more continuation from where we are right now to the price targets that I did highlight. Now, if we come over to our next chart, you can see there's quite a lot of divergences happening right now. For this chart specifically, we're going to be looking at the OBV, which is the on-balance volume. We don't typically look at the on-balance volume on this channel. This is really just another way to quantify the volume, a little bit more of a sophisticated way to quantify the volume than a lot of retail traders do. Like, for example, with these regular volume candles to the downside. If you want to read up more on the OBV, then I will leave a link to Investopedia down below. But like I said, it's kind of just a more sophisticated way to look at the on-balance volume and look at how much liquidity is in this market at this moment in time. So if we are looking at the OBV, what you can see is a lot of the time these mainly just track each other. Sometimes you do have slight divergences which snap back to each other. For example, over here recently, we saw a Bitcoin rally up to 25,000 and the OBV actually made a lower high. And this was telling us that a sizable correction was going to come because the OBV started to break back down after making a lower high, even though the price action made a higher high. And then, of course, the trend continued, OBV made a low, and then it made a lower low, and the price action actually moved from 25,000 all the way down to 19,000. So the last major divergence that happened on the OBV caused about a 22.5% move, and we're seeing this once again. The OBV is really still, making these lower highs. If I kind of separate these two charts, what you can see is the price action is still making higher highs, but the OBV is making lower highs. Now you can see this in the OBV chart. This is actually regular bearish divergence. I will show you this over on the MFI a little bit later on, but I did just want to point this out as well, that when the price action is going up and the oscillator is going down, especially when it's the OBV. So volume is heading up on these retail metrics, but for the OBV, we're not seeing a significant uptick in volume at this moment in time. So what is quite interesting about this is if we pair the OBV, if we pair the volume in this chart over here with the Bitcoin ratio of retail to institutional addresses, like I said, looking at the OBV is a slightly more sophisticated way to quantify the volume. What we can do is we can look at this chart, the ratio of retail to institutional addresses, and when we do look at this, you can see the blue line is pushing up almost to a new all-time high, indicative that right now this rally is being led by retail traders and not institutional traders, not smart money. So this is definitely a cause for concern. You've got the price action dramatically exceeding the OBV heading into the CPI tomorrow, and of course with the OBV making lower highs and the price action making higher highs, this is classic regular bearish divergence, which we can see in this chart over here. Like I said, there are many different oscillators that you can pair this with. For this one, I really just like looking at the MFI when I am looking at my divergences. This is just getting stronger and stronger. If you're a veteran of the channel, we've been looking at this for a while. Since the MFI made a top over here, and the price action made a high and started making higher highs, higher highs, higher highs, you can see that this regular bearish divergence has been forming over on the BTCUSD chart. Now, this has been in play for 85 days, and with this most recent pump, you can see we're once again bashing our heads against this trend line, which we have not managed to break to the upside. And while, you know, if we're removing this trend line, it's of course bullish that we're making higher highs in this market structure. The fact that we're forming this regular bearish divergence on a lot of these different oscillators, specifically the OBV and MFI, really letting us know that, you know, smart money is not entering this market right now. And this is a retail driven rally associated with a lot of bearish divergences. So I'd be a little bit worried about this in the immediate short term if I was a bull. Like I said, in the immediate short term though, I would be leaning short term bullish to 30,750 before we do have that next FOMC meeting. Now, of course, higher time frames really hasn't changed. If we are looking at this red box of resistance, there's definitely multiple ways that you can draw this to. Really, you can draw this to the wicks down here, and we would have just pushed past this. You can see that we've got wicks here, we've got wicks here, we've got wicks here associated with the top of the ranges in May. So, you know, there's really no right or wrong. This is very ambiguous, this box here, as to where the resistance would be in. But really, you know, there's lots and lots of major touch points around this region that quite recently, well, I say quite recently, this was a while ago, May of 2022, we broke down from this and retested this box as resistance and continued to break back down lower into the bear market. And we're once again coming right back into this red box to retest it. So Bitcoin in the higher time frames is in a very important area right now. Stochastic squeeze momentum indicator, we just looked at the MFI as well. The MFI is super overextended up at 80 right now. The squeeze momentum indicator still pushing into green territory, and you can see the stochastic RSI on the weekly time frame is up at 100. And also in our recent videos, we talked about how this divergence has happened before. If we're looking at the price action right here, price action right here, and we look at the stock in both of these regions, what you can see is the stochastic RSI came up to 100, broke back down, made a higher low, and came back up to 100. And what happened in the chart over here on Bitcoin's all-time high is this was associated with a high, a breakdown, a higher high, and then a breakdown further into the bear market. Now, we're seeing the same thing with this kind of like M pattern with a huge blow off top to the upside. You can see this over here. You can see this hill. You made a lower high when the stochastic RSI made a higher low. And once again, you can see this double top in the stochastic RSI is very likely to play out the same way as it did on Bitcoin's all-time high. We've talked about this before, so I just wanted to breeze through this one more time and show you the higher time frame oscillators are not looking too hot right now, while in the lower time frames, even on the daily right now, we are starting to see these divergences form and get extremely strong in the Bitcoin price action. Now, in terms of the SP 500, I only want to spend like 20 seconds on this chart. We've looked at this before. There's really not too much to update. I also posted this over on Twitter. If we remove these lines very quickly, you can see that if you're drawing to candle body closes, or if you're drawing up to the wicks here, we do have a very clear head and shoulders pattern playing out right now for the S&P 500. And if we remove the head and shoulders pattern, you can see this is also associated with a retest of a very, very crucial area for the S&P 500. So this intersection right now that we're retesting before the CPI data, also pairing this with the head and shoulders, is not looking good for the S&P 500. Really not too much to update on that. I really wanted to focus on Bitcoin and of course the CPI data coming out tomorrow. Now let's move on to some economic data from the job report before we do talk about the CPI. On the channel, we recently talked about the US initial jobless claims, letting us know that the unemployment issuance was going up. So a lot of people are filing for unemployment right now in the US. Now, while some people were getting a little bit hot on this data, hoping that a Fed pivot was going to come sooner than expected because of this, since this data come out, we had new job report data letting us know that the labor market is actually very, very strong right now. We've got the labor force participation rate rocketing to the upside right now. It's the strongest that it's been since February 2020. You can also come and see that the unemployment rate, while we do have these large issuances for initial jobless claims, because the labor force participation rate is going up so much, we actually had the unemployment rate go from 3.6% down to 3.5%. Now, why is the unemployment rate very important? We talked about this quite recently. If you've been keeping up with Fed commentary, they've been letting us know that an unfortunate consequence of them tightening their monetary policies, tightening the effects of credit, raising the interest rates, is going to be that the unemployment rate is going to undoubtedly take a large move to the upside. Now, what this signals to us with this most recent job report, with the labor force participation rate going up at this moment in time and the unemployment rate going down, this signals to the Fed that the markets and the economy is strong enough for further rate hikes. Now, since this data has come out, obviously we're still sitting at the 5% interest rate. We don't have our next FOMC decision for another 22 days coming into the 3rd of May. But since this data came out for the job report, the markets are starting to realize that another interest rate hike is very, very likely. Prior to this, the markets were assuming that a 25 basis point increase only had about a 25% probability associated with it, whereas right now we're sitting at around about a 75% probability. This is kind of ticking between 70 and 80 right now. I've seen this as high as 80% yesterday. But, right now the markets are looking like it's very, very likely that we're going to get another 25% increase. And of course, the Fed is going to be looking at this as well, saying, hey, we can further increase the interest rates, we can tighten the effects of credit because the labor force participation rate is very, very strong right now, and the unemployment rate is still at very, very low levels. So the Fed has a lot of work to do still with their tightenings of credit standard, which is why the markets are starting to price in and realize that another 25 basis point increase is the most likely cause for the May meeting. Now, just wanted to touch on that one very quickly. Let's now dive into the CPI data, which is going to be coming out tomorrow. So starting off with the US headline CPI, the last reading that we had over on the CPI year over year was coming in at 6%. And right now, the markets are forecasting that inflation year over year is going to drop down to 5.2%. Now, the index is actually predicted to be up because the month over month index is actually looking to come in this month at a 0.2% rate, still increasing month over month, which means the index is, of course, still moving up. But year over year, we're expected to have a dramatic drop to the downside. Now, I personally do think that year over year CPI is going to be dropping in the March reading. However, I don't think that we are going to be as low as 5.2%. So this may be right now why you're seeing the S&P 500 rally into resistance. This may also lend some credence into why Bitcoin is breaking out to this price target of 30,750. And of course, we know that Bitcoin typically loves to break out ahead of the CPI data and dump after it. So it's very likely that year over year inflation will drop, but tomorrow it's possible potentially we get a forecast around about 5.2, 5.3, 5.5%. And then of course the markets start repricing into the downside as inflation was hotter than expected, but still coming down year over year and heading up month over month. And also another piece of economic data we quite recently had was the US average hourly earnings year over year. This did drop down to 4.2%, previously clocking in at 4.6%. So as you can imagine, if the US average hourly earnings are down, if people are getting paid less, then this is also going to help curtail inflation. So this metric right here is definitely lending some credence into the fact that CPI year over year, while I don't think it's coming down to 5.2%, it's probably definitely going to be coming and dropping down tomorrow. Now, in terms of the US core CPI, this is where we see a very interesting divergence. Now, previously, this came in at 5.5%, and this is actually forecast to increase up to 5.6%. You can see right now that the US core CPI has really not been coming down too much whatsoever. And here's where things get interesting. If tomorrow we have a 5.6% reading for core CPI, what is this going to mean? Well, if we look at headline CPI, headline CPI is forecast to come in at 5.2%. Now, this would be meaning that for the first time in a very long time, core CPI will actually be higher than headline CPI. Now, we've seen this at a handful of occasions. Most notably, we saw this in 2008 when the US core CPI was kind of lollygagging and actually above the headline CPI. This was letting us know that inflation was starting to get very sticky. Now, sticky CPI is something that I've discussed on the channel being a probability for quite some time now. We haven't talked about this in quite some time. About 6 months ago, we talked about how the inflation outlook for core CPI in this video over here, sticky inflation accelerates, was looking to be further sticky, meaning that, while headline CPI may come down, as you can see, if we come back over to core CPI, where is it? Year over year in the past 5 months or so, you can see we really haven't been having too much of a big move down. So inflation is looking very, very sticky in the core components right now. And if we do update the core price CPI for the first time in a very, very long time, if we look at the flexible CPI, we already know what this is. This is kind of like the headline inflation. If we're looking at the sticky CPI, this is basically lining up with core sticky CPI right now. So if I actually get rid of core flexible CPI, you can see these two charts beautifully line up. So why is inflation so sticky right now? We're only showing this chart on the sticky CPI. If we're showing the flexible CPI, we can see there's not a high correlation. If we're showing the core sticky CPI, you can see there's a very, very strong correlation. If we're showing core flexible CPI, you can see there is not a strong correlation. So right now, we know why inflation is being so sticky in the core components. Core CPI is looking very, very sticky right now. And if we are removing the sticky CPI in general and just looking at core sticky CPI, you can see that this has actually been itching up higher. In January and February, we had all-time high readings up at 6.6%. So while core CPI is coming down right now, we're seeing a lot of the slow-moving and sticky components of this really take a very, very long time to come back down to the downside. Some of them are even pushing up. Like we said, the sticky components of the core CPI are moving up. If we're looking at core flexible CPI, it is coming down to the downside right now. So all in all, the general outlook for inflation right now, specifically in the core components, is that this is going to further remain sticky for quite some time, especially if we see the month-over-month increase. If we see core CPI head up tomorrow and we see headline CPI, it doesn't particularly matter what the headline CPI does. I think it'd be very interesting to see the headline CPI at/below 6.5%, meaning that CPI in the core components is either at or above the components in the headline inflation basket. That's definitely another thing the Fed is going to be looking at, like we've been discussing on the channel. We know what the Fed looks at. The Fed is interested in the general health of the economy, which it looks at in the job market, which right now is showing major strength, meaning that more rate hikes can come into the market. And also they like to look at the core components of the CPI, which are right now still being very elevated and super sticky, letting us know that the Fed is, with all of these major metrics that they're looking at, they're definitely going to be leaning more likely to a 25 basis points coming in the May meeting. One final thing I did want to talk about before we do wrap up the video and talk about my Bitcoin sales is the fact that, on on the channel, we talked about how quantitative easing is not coming back. We made a specific video about this down here. Has the money printer returned? We talked about how the money printer hasn't returned. What we saw was the US central bank balance sheet increase, but this was primarily due to discount window loans and central bank liquidity swaps, which we told you were going to be short-lived. And once these were paid back, we would see a decrease in the balance sheet. This was not going to start moving up, indicative that quantitative easing is coming back. And since the last reading, you can see this is actually coming back down to the downside. So a lot of people are talking about quantitative easing. I think within the next month or so, we're going to see the balance sheet all the way back down to around about 8.4 trillion, where it was in February, letting us know that, of course, we have not seen any quantitative easing. This little bump to the upside was, like I said in the video, discount window loans to banks to provide liquidity, and also central bank liquidity swaps. That is by definition not quantitative easing. If you want to learn more about quantitative easing, I'll leave this thread down below where we left the definitions and also talked about, like I said in this video, everything about quantitative easing. What we saw in this rally on the central bank balance sheet was absolutely not quantitative easing, and we are starting to see the effects of this start to wipe away already. Alright, now let's wrap up the video. At the start, I told you I was going to be selling Bitcoin into this rally and also updating my DCA plan. So we'll do just that. If you are a veteran of the channel, you may have remembered the last time we updated the DCA plan was 5 months ago when we were breaking down into new lows. I made this video over here 5 months ago, Bitcoin time to DCA. And in this video, we outlined my entire DCA plan, where I was going to start DCAing down to, at what percentages and at what levels I was going to start buying, and we showed this in this chart over here. Now, obviously, since this video, we have had the FTX exchange go bankrupt. So when I've initially laid out my bear market plan, it was on this FTX chart, which has stopped trading. So what I've done is I've taken this DCA plan and put it over on Bitstamp, which is still trading. As you can see, FTX stopped trading here. Bitstamp is still trading. So this chart over here is the exact same one as we looked at over here, just on a new chart. So what was the DCA plan that I was letting you know ages ago? We were going to be DCAing as we broke down to 25. I was going to buy at 25, 24, 23, 22, 21, 20, 19, 18. And then I told you round about 18, as we were breaking down in this video, you can go back, check this. On my Twitter, you can go back, check this, where we were talking about how I was going to be aggressively DCAing into the market. I was buying aggressively at 17,000 and 16,000, as you can see right here, these two levels where I was going to associate 60% of my entire DCA plan in these 4 levels. So obviously with these 2 levels, I DCA'd about 30% of my available capital. We hit all of these DCAs over here. So we DCA'd a sizable chunk. We bought pretty much at the exact low down here at 16,000. We obviously didn't come down to my 15,000 buy because we bottomed at 15,500. Now, I say bottom, I believe this is a local bottom. I don't believe we've seen the bear market lows yet. But what I am saying is, from these purchases down here, from these DCAs that we put at 17,000 and 16,000, specifically from 16,000, at this moment in time, they're almost 90% up. They've almost doubled. Literally right now, they're sitting up 89% on my spot DCAs from 16K. So what I'm going to be doing is I'm going to be selling the DCAs that I made down here at 16,000 on spot. What happens from here, I'm basically going to be selling at this exact level. In fact, I've already sold before I recorded this video. I sold and then wanted to come and update you on what I'm doing. Also, I did just want to show you once again, in the higher time frames, we are running into quite a steep area of resistance, and we do have touch points right around 31,000, and we've got touch points up here at 32,500. So what I'll also be doing is, once again, I'm selling the Bitcoin that I purchased down here at 16,000 for an 89% spot increase. Even if you think the bottom is in, this is a massive, massive rally that has happened in just like 4 or 5 months. So whether you're bullish or bearish, a sizable pullback to around about 25,000 is definitely looking like the most likely course. Whether you think we're going to head up higher from there, or whether you think we're going to head down lower from there, we're very, very overextended. And just like everything we've looked at, especially with the divergence we're having from the OBV right now, things are letting me know that this is really a retail-driven rally and will soon be taken back down to the downside. With my purchases at 17,000, I will be selling them into the market if we do push up to 32,000. Not 100% sure if we're going to go up to this level. I'm just letting you know I will be putting in sell orders at 32,000. So bear in mind, this is my spot portfolio. All of the purchases that I have between 25k down to 17k, these are going to remain in my ledger. These other ones down here are kind of getting ready to be dumped on the open market right now. So what I do want to kind of wrap up on one final thought is, while I am selling my spot portfolio right now down at these lows, I do want to let you know, am I telling you that you should sell everything at these levels? No, I don't know what your DCA plan is. I don't know how long you have been in Bitcoin for. I don't know how long you plan to stay in these markets for. I've been in Bitcoin since around about late 2016, 2017-ish. And I've been DCAing for a very, very, very long time. I've got Bitcoin that's in a ledger that hasn't been touched in, 5 or 6 years or so. So my DCA plan, my sells on these purchases down here may not line up with your plan. Your entire portfolio may have been purchased down at these levels. For me, this is really the cherry on the top of the cake. So like I say, always make sure to do your own analysis. Always make sure to formulate your own plan. Don't just listen to what one person says. Make sure that you understand all of what's going on in the market right now. Make sure you understand what you're trying to achieve. For me, like I said, I've been purchasing since 2016, 2017. Maybe it was early 2017, maybe it was late 2016. I don't 100% remember, if I'm honest. But with that being said, I do have long-term Bitcoin that I will not sell anywhere near these levels. The Bitcoin that I'm selling right now, that I purchased at 17,000 and 16,000, is really a small part of my portfolio in the grand scheme of things. Like I said, I am a long-term holder of Bitcoin. I've got Bitcoin I purchased back in 2016, 17, 18, which will not see the light of day until Bitcoin is trading at least, hundreds of thousands of dollars or so. So, with that being said, always make sure to understand what your plan is, understand how your plan differs from my plan. I don't know how much Bitcoin you hold. I don't know how long you want to be in this market for. So I can't say whether you should be selling here right now or not. But for me, witnessing these purchases, these spot purchases go up almost 90%, almost doubling, and witnessing everything that's happening in the markets right now with these divergences, I will be selling the Bitcoin that I purchased at 17,000, and if we do push up to 32,000, I will be selling that as well. So for today, my friends, that's all I've got. As always, if you do enjoy the content, let me know down below by leaving a like and a comment. Share the videos with your friends. If you want to further support the channel, feel free to click the join button and become a member down below. I will, of course, also be updating what happens with my price targets on this rising wedge, updating the CPI data that comes out tomorrow. As always, it's been your boy Cowboy Trades. I'm out. Peace.